Hello, and welcome to the Retirement Wealth Podcast. I'm so glad you're joining us today.
It's great to be here, Emily. We have an interesting topic to dive into that I think a lot of folks will find really useful.
Absolutely. We're talking about the classic debate of stocks versus bonds in a retirement portfolio. It's something that can really impact your financial future.
Right, and it's crucial for anyone planning for retirement or already retired to understand the roles these investments play.
We'll explore the benefits and risks of both, discuss how they can work together, and share some strategies for balancing them in your portfolio.
Plus, we'll touch on how your risk tolerance and retirement goals can influence your choices. It's all about finding the right mix that suits you.
Yes, and we'll also answer some common questions we hear, like when to shift from stocks to bonds, or how interest rates might affect your decisions.
Exactly. So whether you're just starting to think about retirement or you're already enjoying it, there's something here for everyone.
Let's get started then. David, can you kick us off by breaking down the main differences between stocks and bonds?
Sure, let's dive right in. So, Emily, with everything going on in the economy right now, it's really crucial for folks to understand the dynamics between stocks and bonds, especially as they approach retirement.
Absolutely, David. I think a lot of people are feeling the pressure of the current market volatility, right? With inflation still being a concern, it's hard to know where to put your money.
Yeah, inflation can really eat away at purchasing power. I mean, consider someone who's planning to retire in the next few years. If they're relying too heavily on cash or low-yield bonds, they might find themselves struggling to maintain their lifestyle.
Right, and that's a real fear for many. I recently spoke with a friend. Let's call him Tom. He's planning to retire next year, but he's worried because he's been mostly in bonds, thinking they're safer. With rising inflation, he's realizing that those returns aren't keeping up.
Exactly. And then there are people like Sarah, who's a few years away from retirement. She was heavily invested in stocks, and after a recent market dip, she panicked and sold off a chunk of her portfolio. Now she's worried she won't have enough when she retires.
That's such a common reaction, isn't it? The emotional side of investing can be so challenging. It's easy to let fear drive decisions, especially when markets are unpredictable.
It really is, and that's why having a balanced approach is critical. A diversified portfolio can help mitigate some of that emotional stress. But, it's not just about stocks and bonds. It's also about understanding how these investments fit into your overall retirement plan.
For sure. And with changes to Social Security on the horizon, it's more important than ever to be proactive. I read recently that some benefits might be adjusted due to funding issues, which could impact retirees' income.
That's a significant factor. People need to factor in their expected Social Security benefits when planning their retirement income. If they're counting on those benefits being stable, they might be in for a surprise if adjustments occur.
And let's not forget healthcare costs. They keep rising, and that's something many people underestimate when thinking about their retirement budget.
Absolutely. I spoke with a couple, Mark and Lisa, who are in their late 50s. They've saved diligently, but hadn't really accounted for health insurance premiums and out-of-pocket expenses. Now they're reevaluating their strategy to ensure they can cover those costs without dipping too much into their savings.
That's so important. Planning for healthcare and retirement can feel overwhelming. And with so many options available, it's hard to know what will work best for your situation.
Right, and that's where the balance between stocks and bonds comes into play again. If you have a well-structured portfolio, you can have more confidence in your financial security, which ultimately eases some of that emotional burden.
It's like a safety net, isn't it? Knowing you have a diversified strategy can help you sleep better at night.
Exactly. And let's not overlook the legacy aspect. Many retirees want to leave something behind for their families. If the market takes a downturn and your portfolio isn't balanced, it could affect what you're able to pass on.
Oh, that's so true. I think a lot of people want to ensure they're not just providing for themselves, but also for their loved ones. A solid strategy can help secure that legacy.
Yes, and with the current economic trends, it's essential for people to look ahead. We're seeing shifts in interest rates, and that can impact bond prices in particular. If rates are rising, existing bonds could lose value, which is something everyone needs to consider as they approach retirement.
That makes sense. So it's really about understanding not just where the market is today, but where it might be heading in the future and how to position yourself for that.
Exactly. And let's not forget about tax efficiency. With the potential for tax changes down the line, having a mix of accounts, like traditional IRAs, Roth IRAs, and taxable accounts, can offer some flexibility in managing taxes in retirement.
Yeah, and that point about tax efficiency is often overlooked. Retirees need to think about how their withdrawals could impact their tax bracket.
It's all interconnected, isn't it? The more you understand how each piece fits together, the better prepared you'll be.
Definitely. And speaking of preparation, it's essential for people to have a clear retirement timeline in mind. If you're looking at retiring in the next few years, your strategy will be different than if you have a decade or more to go.
Right. Those closer to retirement might need a more conservative approach, while younger investors might focus more on growth through stocks.
And that's where personalized planning comes into play. Everyone's situation is unique, and having a tailored strategy can make a huge difference.
Well said. It's about creating a roadmap that considers not just your financial goals, but also your emotional comfort with risk.
Exactly. And with that, I think we're ready to dive into some core strategies that can help our listeners make the most of their portfolios, right?
Absolutely. Let's explore those strategies next. So, Emily, when we think about stocks versus bonds in a retirement portfolio, it really boils down to understanding what each of these asset classes brings to the table, right?
Absolutely, David. Stocks tend to offer higher growth potential but come with more volatility, while bonds are generally seen as safer, providing more stability and income.
Exactly, and that's a key consideration for retirees. You want to balance growth with safety. A common rule of thumb is the 100 minus your age guideline. So if you're 60, for instance, you might consider having 40% of your portfolio in stocks and 60% in bonds.
Right, but that's just a starting point. Individual risk tolerance and financial goals are super important too. Some people might feel comfortable with a more aggressive allocation, especially if they're aiming for long-term growth.
Totally, and let's not forget about the role of tax-advantaged accounts like 401ks and IRAs. They can influence how we allocate between stocks and bonds. For instance, if you have a traditional IRA, you're deferring taxes until withdrawal, which can impact your strategy.
Yes, that's why it's crucial to consider where your investments are held. You might want to put more tax-efficient investments, like stocks, in taxable accounts, while holding bonds in tax-advantaged accounts to minimize taxes on interest income.
Right, and then there's the Roth IRA, which is interesting because you pay taxes up front. So, having growth assets like stocks in a Roth could be a smart move, since withdrawals are tax-free in retirement.
Exactly. And speaking of withdrawals, the 4% rule is something many people rely on. It suggests that you can withdraw 4% of your retirement savings each year without running out of money, assuming a balanced portfolio.
That's a great point. But it's important to remember that the 4% rule isn't one size fits all. Market conditions, your specific expenses, and even life expectancy can influence how much you should withdraw.
For sure. And that's where strategies like the bucket strategy can come into play. You separate your assets into different buckets based on when you need them.
Right, so you might have a short-term bucket for immediate expenses, which would be more conservative, maybe in cash or short-term bonds, then a medium-term bucket for income in a few years, and a long-term bucket that's more aggressive, focused on growth.
It's like a layered approach, which can help mitigate risk while still allowing for potential growth. And let's not forget about diversification. Having a mix of asset types can really help reduce volatility.
Exactly. You don't want to put all your eggs in one basket. A diversified portfolio can include stocks, bonds, real estate, and perhaps even some alternative investments like annuities.
Speaking of annuities, they can provide guaranteed income, which can be super comforting for retirees, but they can also come with higher fees and less flexibility.
Right, it's essential to understand the terms when looking at annuities. Some might have surrender charges if you withdraw early, or they might not keep up with inflation.
Great point. And inflation is something we can't ignore. It can erode your purchasing power over time, so it's wise to have some growth-oriented investments in your portfolio.
Absolutely. That's why many financial advisors suggest a mix of stocks and bonds that aligns with your risk tolerance and financial goals.
And then there's Social Security optimization, which plays a huge role in retirement income. deciding when to take benefits can really impact your overall strategy.
Yes! Waiting to take Social Security can increase your monthly benefits significantly. For every year you delay past your full retirement age, your benefits can increase by about 8% until age 70.
So, for some people, it might make sense to wait, especially if they have other income sources or are healthy enough to expect a longer life.
Exactly, and that's a great segue into withdrawal strategies. You want to make sure you're not just blindly following rules without considering your unique situation.
Right, and with required minimum distributions or RMDs, kicking in at age 72 for traditional IRAs and 401ks, planning for those withdrawals is critical.
Definitely. If you're not careful, those RMDs can push you into a higher tax bracket, so having a strategy to manage your withdrawals is key.
And that ties back to tax savings techniques. For instance, if you have taxable investments, you might want to consider selling investments that have lost value to offset gains elsewhere.
Exactly, that's called tax loss harvesting. It's a way to minimize your tax bill while rebalancing your portfolio.
And we haven't even touched on real estate yet. Many retirees look to downsize or invest in rental properties for additional income.
That's true. Real estate can be a solid investment, but it also comes with its own risks and responsibilities. It's essential to do your homework.
And remember maintenance costs, property taxes, and potential vacancies. Those can all eat into your returns if you're not prepared.
Right, so diversifying into real estate can be beneficial, but it's important to weigh the pros and cons, just like any other investment.
And with all these moving parts, it's easy to feel overwhelmed. That's why having a comprehensive financial plan that considers all these factors is so important.
Absolutely. When you create a holistic view of your finances, you're better equipped to navigate retirement.
So, with all this in mind, what are some common pitfalls you see people falling into when it comes to their retirement planning?
Well, one of the biggest mistakes is not having a clear plan or sticking to it. Many people underestimate their expenses in retirement, which can lead to shortfalls later on.
That's so true. And then there's the pitfall of being too conservative or too aggressive with investments, which can really impact long-term growth.
Yes, and ignoring the impact of taxes on withdrawals can also be a significant oversight. It's essential to strategize around tax implications.
Right, and we've talked about so many strategies today, but it really comes down to finding the right balance for your unique situation.
Exactly. And that's why regular reviews of your retirement plan are crucial. Life changes, markets change, and your plan should evolve accordingly.
So let's dive deeper into those common pitfalls next, and how to avoid them effectively.
So, Emily, one of the biggest pitfalls I see with folks planning for retirement is what we call sequence of returns risk.
Right, that's when the order of your investment returns can really impact your portfolio, especially in those early retirement years.
Exactly. You could have a great long-term average return, but if you experience a couple of down years right when you start withdrawing from your savings, it can really hurt.
Yeah, I imagine that can feel pretty devastating, especially when people think they have a solid plan in place.
I had a client, let's call her Linda, who retired in 2008, right before the market crash. She had a good amount saved, but she started withdrawing from her portfolio during that downturn.
Ouch, that's tough.
It really is. By the time she realized what was happening, her portfolio had taken a serious hit, and she ended up having to change her lifestyle significantly.
That's such a good example of how timing can be everything.
Right, and it emphasizes the importance of having a strategy that considers not just how much you're withdrawing, but also when you're withdrawing it.
So what can people do to mitigate that risk?
Well, one approach is to have a diversified portfolio that includes some safer assets like bonds.
And maybe even cash reserves, right?
Yes, exactly. Having a cash reserve can help you ride out those market fluctuations without having to sell your investments at a loss.
That makes so much sense. What's another common mistake you see?
Ignoring taxes in withdrawals can be a big oversight. Many retirees underestimate how much they'll owe in taxes when they start pulling money from their accounts.
Yeah, I bet that can lead to some unpleasant surprises.
For sure. I once worked with a couple, Tom and Sarah, who had saved diligently but didn't account for the tax implications of their withdrawals.
What happened?
They were shocked to find that their tax bracket bumped up significantly once they started taking distributions, which meant they ended up with less money than they planned for.
That's frustrating, especially when it could have been avoided.
Absolutely. It's crucial to have a tax-efficient withdrawal strategy. It's something that really deserves attention, especially as tax laws can change frequently.
So what's a good rule of thumb when it comes to tax-efficient withdrawals?
A common strategy is to withdraw from tax-deferred accounts first, like traditional IRAs. But it really depends on your individual situation.
Got it. What about healthcare and longevity?
That's another big one. Many people underestimate their healthcare costs in retirement.
They can be astronomical, can't they?
They really can. I had a client, let's call him Mike, who thought he had it all figured out.
But
He was healthy, so he assumed his medical expenses would be low. But then he faced an unexpected health issue and his expenses skyrocketed.
that must have been a real eye-opener for him.
Yes, it was. He hadn't planned for long-term care, and it put a significant strain on his finances. It's important to consider potential healthcare costs and how they can impact your retirement plan.
So a good way to prepare would be to research long-term care insurance or set aside a separate fund for healthcare expenses.
Exactly. And it's also about understanding your own health history and family trends. Those can give you clues about what to expect in the future.
All right, let's shift gears a bit. What about asset allocation?
Poor asset allocation can definitely derail a retirement plan. Many retirees are still heavily invested in equities, which can be risky as they age.
I imagine that could lead to some sleepless nights, huh?
Absolutely. I had a couple, Bob and Carol, who were still 80% in stocks when they retired.
Wow, that seems risky.
It really is. They thought they could weather the storms, but when the market dipped, they panicked and sold at a loss.
That's such a tough lesson to learn.
Yeah, it is. A balanced portfolio, especially as you age, is essential, shifting towards more conservative investments to protect those hard-earned savings.
And speaking of tough lessons, what about claiming Social Security?
That's a big one too. Many people claim it too early without understanding the long-term consequences.
Right, because if you claim early, you might be leaving a lot on the table.
Exactly. I had a client named Susan who claimed her benefits at 62 because she wanted the immediate cash flow.
But
She didn't realize that waiting until her full retirement age would have given her a much larger monthly benefit.
that's a classic mistake.
Yeah, and it's so important to understand the implications of your claiming strategy.
So what's a good takeaway for listeners to avoid these pitfalls?
I would say to regularly review your retirement plan. Keep an eye out for red flags like unexpected market dips, rising healthcare costs, or tax implications that could throw your plan off course.
And having a financial advisor can really help with that, right?
Absolutely. They can guide you in making adjustments to your strategy, ensuring you're on track for your retirement goals.
So the key is to stay proactive and informed, rather than reactive and surprised.
Yes, exactly. And even if you've made some of these mistakes, it's not too late to adjust your strategy or seek help.
That's such a reassuring message.
It's all about learning and adapting, you know?
All right, so what's next for our listeners?
Let's talk about actionable steps they can take to recover or avoid these pitfalls. All right, Emily. So let's dive into some actionable steps listeners can take right now to really kickstart their retirement planning.
Yeah, that sounds great. I think a good starting point is to check out those retirement calculators, right?
Absolutely. Websites like Vanguard, Fidelity, and Schwab offer fantastic retirement calculators. They can help you estimate how much you need to save, what your monthly expenses might look like, and even project how your investments could grow over time.
That's so true. And I love how interactive those tools are. You can really plug in your own numbers and see the impact immediately, which is super motivating.
Right? And don't forget about SSA.gov. It's a great resource for checking your Social Security benefits. You can see what you're entitled to and factor that into your overall retirement strategy.
Yeah, and I think a good habit to develop is to review your portfolio regularly, maybe quarterly. Just taking that time to look over your investments can make a big difference.
Definitely. And while you're at it, running retirement projections can be really eye-opening. You can see how different scenarios might play out. It helps you stay proactive instead of reactive.
And speaking of being proactive, Using tax software can also help you maximize your retirement savings. Understanding your tax situation can lead to better investment decisions.
That's a key point. You can use tools like TurboTax or H&R Block to get a clearer picture of your tax obligations and opportunities.
And if someone wants a more hands-on approach, financial planning apps can be really helpful too. Apps like Personal Capital or Mint can help track spending and savings in real time.
For sure. Those apps can provide insights into where you might be overspending and where you can save more for retirement.
And if anyone is looking for some deeper knowledge, I'd recommend a couple of books. The Boglehead's Guide to Retirement Planning is a classic.
Oh, absolutely. And Your Money or Your Life is another fantastic read. It really reshapes how you think about money and retirement.
There are also some great podcasts out there. I've heard The Mad Fientist has some awesome tips for optimizing your financial situation.
Yes! And ChooseFi is another one worth checking out. They focus on financial independence and have a lot of practical advice.
So it seems like there are plenty of resources out there. But I think the key is to start small, right? Like, even just setting aside a little bit each month can add up.
Exactly. It's never too late to improve your plan. Even small adjustments can lead to significant changes over time.
And setting specific goals can help too. Whether it's saving an extra $50 a month or reviewing your portfolio quarterly, every little bit counts.
Right. And remember, it's about progress, not perfection. Just take those steps one at a time.
Yeah, and keep in mind that the journey toward retirement planning can be a marathon, not a sprint. Making consistent efforts will pay off.
So those are some practical first steps. Now let's bring this all together. Well, as we wrap up this episode, let's recap some of the key points we discussed about stocks and bonds in retirement portfolios.
Absolutely. First off, we talked about how stocks, while they can be more volatile, offer the potential for higher long-term growth, which can really benefit your retirement savings over time.
Right, and then we highlighted the role of bonds, which provide stability and income, especially when markets get a bit shaky. They can be a great way to balance out that risk.
And let's not forget about the importance of diversification. Spreading your investments across both stocks and bonds can help cushion against market fluctuations, right?
Exactly, Emily. It's all about finding that right balance that aligns with your risk tolerance and retirement goals. And we also touched on the need to regularly reassess your portfolio as you approach retirement.
Yes, that's so crucial. Staying proactive can really make a difference in maintaining your retirement wealth.
And let's encourage our listeners to keep building and protecting that wealth. It's a journey, and every step you take counts toward a secure and enjoyable retirement.
For sure. So if you found value in today's discussion, we'd really appreciate it if you liked this episode, subscribed to the channel, and maybe even shared your biggest takeaway or any questions in the comments.
And don't forget to share this with anyone you know who's planning for or already in retirement. They might find it helpful.
Next time, we'll dive into something really interesting. Tax-free retirement income strategies explained. You won't want to miss it.
It's going to be a great discussion, so be sure to tune in.
Thanks for joining us today, and we hope you have a wonderful day ahead.
Take care, everyone.